All right, guys, so here's the deal. Everyone knows that when done correctly, real estate is one of, if not, I'd argue it's probably the best investment that you can make. However, we've all heard those horror stories of people losing their shirts in real estate, and it probably has you second guessing as to whether or not it's something that you want to get into. So in this video, I share with you the 3 things to look out for when investing, which essentially just boils down to the 3 ways that you don't want to invest in real estate so that, again, you don't become a cautionary tale. Hey, if we're just meeting for the first time, my name is Vargas from the Vargas team, and I share with you all things real estate related, so consider subscribing if that is something that you're interested in. So as a real estate investor, you have to be very disciplined to set a criteria for your investments, and you only want to buy properties that meet that criteria. And trust me, guys, I know how tempting it could be when you want to buy something that you otherwise wouldn't, just because you want to get into the real estate game or because it's been a while since your last deal. So if you haven't done so already and you haven't clearly specified your criteria, now is a good time to take inventory of what's important to you and outline your non-negotiables. For example, as a buy and hold real estate investor myself, I only want to buy rental properties that produce an over 8% cash on cash return, and it has to be a multifamily building, so a duplex or up, and I want to avoid single family homes and condos. Not that there's anything wrong with those per se, because I know a bunch of clients of mine that are multimillionaires that both own condos and single family homes, but at least for me, the type of real estate investing I want to do and where I see my portfolio in the next 5 to 10 years is very multifamily based, and that's the preferred choice of investment that I've decided to make. That leads us into the first way not to invest, and that is when you're looking to invest solely based on appreciation. What this means is you're looking to buy a piece of real estate, let's say for $200,000, and your hopes are that by sitting on this property for a few years, the market value would just naturally increase it to where you can sell, say 4 years down the road for a $300,000 sell price, making for a nice $100,000 gain. This is the type of real estate investing that many new investors are first introduced to, and what most people think real estate investing is all about. As great as appreciation is, to me, it should always be looked at as a bonus and not the main focus. Take, for example, my investment properties. I am far more concerned about the rental income and making sure that it's sufficient to cover all of my expenses and then some to make the holy grail of what I consider it to be cash flow. And I'm more concerned about that than I am about how much the property appreciates. If the property appreciates while I'm making a monthly return, then great. And if it doesn't, that's okay too, because I'm still cash flowing, which is the most important thing. The property to me in that case is still an asset. In other words, the second I have to come out of pocket to cover the carrying cost to just hold on to the property, to me is when the property becomes a liability. Buying real estate and arbitrarily coming up with a number that you hope it's going to sell for in the future due to natural appreciation is no different than you going to the roulette table in a casino and just placing a bet all on red. Can you get lucky and buy the right property at the right time? Sure, I think that can happen, and crazier things have happened for sure. And with today's crazy market, I believe that luck may likely be on your side. But to me, luck doesn't pay the mortgage, and you need something a bit more sustainable, dependable, and stable. So guys, look, do me a favor. Don't get lured into buying a property because someone told you that the values are going to skyrocket, and all you have to do is sit tight, because no one could tell you the future and no one knows exactly what's going to happen. So that's not a way that you want to invest moving forward. And speaking of the future, that leads me into the second way you should avoid investing in real estate, and that is by going off of the pro forma for a property. A pro forma, for those of you who don't know, is basically a projection of what a real estate property is likely to create or receive in the not so distant and distant futures. This analysis is provided by the listing broker who is selling the property. So essentially, this pro forma is guessing what the future may look like, and you can see as to why I have a problem or an issue with this type of investing. As I mentioned, no one could determine with any certainty, if you will, what's going to happen in the future. If anything, 2020 is a prime example of that. So your real estate investment then should not be, or your return should not be based on your future projections. In other words, your investment needs to make sense today, right now, in the current market that you're buying in. I see this all the time with buy and hold properties and investors. They're lured into a low return and are sold a bag of goods, saying that the return will dramatically increase over the next few months or years because the market's going to get better and it's already really hot, and thus it's going to appreciate. And look, maybe it will, maybe it won't. I don't know who does. But the point is, if it doesn't, then you're stuck with a property you don't want because you're not making the return that, again, meets the criteria that you set forth. There is a difference, however, when you're buying a property that's under market value or the rents are under market value. If you know as an investor that you can dramatically increase the rental amount doing a few simple cosmetic changes or by simply removing the legacy tenants that are there and your return will increase, then in this scenario, yes, it's okay to accept a very low return on your year one, if you will, while you make those updates and increase the rent back to where it matches your return of the criteria you set. But I'm not talking about those changes. In many cases, what I'm referring to is in the case of proformas where they give you a proforma where you already know that the rents are at market value or very close to market value. So trying to push it up just by natural appreciation, going off of the proforma and knowing that the current numbers don't make sense, but hoping that the proforma numbers will, is just to me a very bad way to purchase real estate and a way that many real estate investors when buying get themselves into trouble. And always think of buying real estate as in the worst case scenario. Let's just assume you buy the property, rents never go up. Are you okay with that return? And if you're okay with that return, then it's probably a good deal for you to buy. The last one, or the last way you shouldn't buy real estate or invest in real estate, is a little bit controversial. And I know not everyone's going to agree with me, but I do have my reasons. And the last way, to me at least, that you should avoid investing in real estate is by buying an investment property in cash. The biggest reason as to why I say not to buy in cash is because you can get a higher cash on cash return using leverage than you would if you just bought the property outright. Let's assume for a second you purchase a duplex for $200,000. And guys, if you find a duplex in Miami or in South Florida for $200,000, let me know because I'd be more than happy to take it off your hands. But let's just assume for the sake of this argument that you find one and you can rent each side for $1,500 a month. So it's a duplex. So of course, $1,500 a month means it's making $3,000 a month. So using very simple math, let's calculate the expenses. The expenses for the property, let's assume, are $300 a month per taxes, $200 a month for insurance, another $200 a month for property management, and another $200 for repairs and reserves. So your total net operating income after you subtract all the expenses is $2,100, which multiplied by 12 is going to equate to $25,200 a year in profit. You guys with me so far? Cool, because in this scenario, you bought it cash. So your overall return on those $25,200 is 12.6%, which is amazing. I mean, I may add that's a very good return. But let's see how using leverage would change your return. Using that same example, let's assume instead of purchasing it for $200,000 down, you put 25% down and you obtain a loan for the other 75%. That means instead of spending $200,000, you only spent $50,000. And in this scenario, I'm going to use a rate factor of 5% just to keep everything super simple. So the loan for $150,000 at 5% would basically mean that your total monthly mortgage payment is going to come out to $625. So now, calculating the same expenses that we've had, this is how that's going to break down. So you are still making $3,000 a month in rental income. Now you subtract the $300 in taxes a month, the $200 in insurance a month, the $200 in property management, the $200 in repairs and reserves. And now lastly, add to that another $625 that you're going to subtract for the monthly mortgage payment. So now that leaves us with $1,475 per month, which when multiplied again for those 12 months, it's going to be $17,700 per year in profit. Now, those $17,700 a year divided by the only $50,000 you put down or you have tied down to the property gives you a staggering 35.4% return on your investment, which obviously I don't need to tell you that that's way better than 12.6% return that you were getting when you bought the property cash. And the best part of all, at least to me, is you still have $150,000 left to go and buy other properties with. So not only is your return that much better, but you can scale your portfolio that much quicker. And after all, being a real estate investor just means getting as many properties as fast as possible or in the shortest amount of time as possible so that you can actually increase your passive income. There are some minor exceptions in which it may be better to buy cash. So I definitely don't want to give you the wrong impression that buying cash is never a good idea because I have plenty of clients who have bought cash and are very serious investors. But to me, buying cash has always been a way to get a smaller return, and it's much better to leverage the financing. But what ways can I say that it's better to buy cash? Well, in many cases, sellers take cash deals much more seriously than they were to take financing deals in most cases, right? So that means that you as a buyer, as a cash buyer rather, are going to be able to negotiate better terms and thus you probably get a better deal on the property than if you would have just used leverage. But in many cases, if you can buy the property and still get a good deal, you'll 9 times out of 10, when you compare the two, you're going to get a much better return using leverage. So definitely take that into consideration. Even if you can buy the property, maybe try to split up that cash into a couple purchases, and you'll see that your buying power goes up and that your return is going to be much better. So what do you guys think? What are some of your non-negotiables when investing in real estate and that you've seen other investors partake in that you would never ever do? Let me know in the comment section below, and don't forget to like and subscribe to the channel to really help the channel out, and click that notification bell so that you can be notified of my next week's video. And as always, guys, thanks so much for watching and tuning in, and I'll see you all next week. Cheers.